More than 80 countries, about half of the global population, goes to the polls this year. It's a historic amount of elections. Some surprising results like this weekend's election in France, but one thing that's sustained so far across many of them, backlash against incumbents. So what does that mean for risk in the markets? Well, joining us now is Afsaneh Beshlas, Rock Creek Group founder and CEO. It's great to have you back on the show. Welcome.
Great to see you, Morgan.
So it has been interesting to see with just the election outcomes in the UK and France over the past week, the fact that there has been this pushback towards incumbents. We've seen some significant changes through these election outcomes to prospective future policy. An injection, I would argue, of volatility into the markets, not just domestically, but globally. How does this now play out? How does it reflect back on what we've seen across the global economy?
It's been so interesting when the French snap election was called. You remember just a few weeks ago, you had French markets fall by 7%. The very interesting thing that happened over the weekend is how UK and France sort of ended up in the same place, in the sense that they ended up with left and left-centrist governments, but in such different ways. In France, you expected Marine Le Pen's party, the very far-right party, to be the winner of this race. And it was a very big surprise over the weekend when they did not win. And you saw the impact on the market being, I would say, relatively positive, in the sense that French markets today were sort of sideways, slightly down. Although in the longer term, because you've got the three parties all with different shares in terms of their election results, but with this big surprise, there probably will not be a very big impact in terms of new economic changes in France. Right. The UK was completely different, though. UK Labour came back very strong. It was expected to win. And Labour really won on bringing stability, job creation, growth. So very different things than maybe Labour of the past.
Okay. So given the fact that we've just come out of these elections in both the UK and France, given the fact that you do have an ECB that has already started to cut rates and BOE that is expected potentially to start very soon here, does it mean that Europe is investable?
So Europe has become more investable. There are different parts to Europe. France obviously has been becoming more like Southern Europe. UK has done really quite well on the expectation that this Labour government would be winning and would be changing economic policy. So if you look at equity markets in the UK, they've done quite well. Other parts of Europe, like the Netherlands, Denmark, of course, with this particular stocks they've had, whether it's clean energy on one side or on certain drugs for weight loss on the other side, has done really quite well as well. So when we talk about Europe, it's very different kinds of markets with very different politics and very, very different markets.
Afsaneh, good to see you. So the Trump presidency was characterized in part by tariffs and some breakdowns in traditional global alliances. The betting markets are seeing more likelihood of another Trump presidency over the past couple of weeks. How does that affect the way one invests?
The interesting thing with increased potential for the Trump presidency is how it has impacted. Initially, you saw after the debate, interest rates go up slightly because it's seen as a highly inflationary impact if that was to come. And the reason for that is obviously immigration policy will be more restrictive, so wages would be up. Tariffs, as you said, would be up, so that would increase prices of goods. But I would say on top of all of that, it's what you and Morgan said earlier, which is sort of this volatility, which in the U.S. has been extremely low at around 12%, at VIX with a VIX level of 12 as we speak, is most likely to go up as we get closer to November. And if the chances of a Trump presidency becomes even higher, uncertainty increases. Markets don't like uncertainty, and that could have a very major negative impact.